Shayan Masoudpour, Managing Director at Bow River Capital. Bow River is a diversified alternative investment firm based in beautiful Denver, Colorado. We offer 8 strategies focused exclusively on the middle market. We're investing out of our third fund focused on essential outsourced services. Within private equity, we focus across industrial services, business services, and healthcare services. At the more senior levels within our team, we do specialize. Like, for example, I've been a career healthcare services investor, going back to 2012. Just given the nuances in healthcare, that's where I spend almost all of my time. It's being in a market where you have multiple ways to win. I mean, that's really what it comes down to. Like, we never want to be single-threaded. We want to have multiple ways to ultimately get to our return. And fundamentally for us, like, the organic and operations piece is what comes first. The advice I'd give someone else, or frankly myself going back, is don't be too cynical. Always focus on how can I solve this problem. The right solution, though, sometimes is saying no, but sometimes it's here are the issues, here are the risks. How am I well suited to mitigate those? Can you figure out how not to aim? I'm trying to think of all the bad metaphors I can now, but how to not aim at the pin that's on an island, maybe the fat part of the green, get yourself to safety and still get home. Those are the opportunities that will cross your desk more often than not.
We are here in Vegas for a conference, and we peeled out to play a little golf at Paiute on the Sun course here with my buddy Shayan. You want to introduce yourself to everybody?
I'm Shayan Masoudpour, Managing Director at Bow River Capital. Bow River is a diversified alternative investment firm based in beautiful Denver, Colorado. We offer 8 strategies focused exclusively on the middle market. We're investing out of our third fund focused on essential outsourced services.
Y'all have 8 strategies. Where's your time spent?
Yeah, my focus is almost exclusively on our private equity strategy. All of the investment teams have dedicated teams and investment committees that are institutionalized within that strategy. But we do get to share the benefits of having a world-class back office that supports all of those 8 strategies, as well as the learnings that come from working across a private equity fund, having real estate in-house, or having credit in-house, or having a secondary strategy sub-market.
Do the partners or the deal teams have verticals that they focus into? I know y'all have 8 different strategies, which...
We do, yeah. So most of our conversation probably would make sense to focus on the private equity strategy where I sit. Within private equity, we focus across industrial services, business services, and healthcare services. At the more senior levels within our team, we do specialize. Like, for example, I've been a career healthcare services investor, going back to 2012. Just given the nuances in healthcare, that's where I spend almost all of my time. I have colleagues who spend almost all their time in industrial services, who straddle industrial and business services as well.
So for like middle market private equity, are y'all investing out of one fund?
We've raised 3 funds now within the dedicated private equity strategy. So yes, it is sequential drawdown funds that we invest in.
Got it. Yeah. So you're closing one out, or like one's alive, and you're
correct.
Yeah. So when you're thinking about how y'all stack up against the rest of the private equity market, how do you define yourself, or what differentiates y'all? Yeah,
it's a great question. Private equity is big and quite diverse. We have a few differentiating factors. We focus on the lower middle market. We are typically the first institutional capital in, and thus are really focused on being founder-friendly, having founder-friendly terms, structures, working with those founders in some cases from transitioning businesses from G1 to G2 in planned successions. We do focus on operations more so than financial engineering, so we typically use less leverage than a lot of our peers. We have higher rollover equity. The terms are pari passu is the fancy Latin term, but we put ourselves in pari passu.
I don't know what that means.
Out of the 2 Latin words I know, so hopefully this isn't a Latin quiz, but all things considered, same class of stock as our founders, full transparency, really a commitment to growing that business organically, and then layering on acquisitions to really turbocharge that growth, but prioritizing organic growth, building teams, retaining folks, and ultimately moving that business into whether it's the right end markets, the right revenue mix, the right geographic markets, diversifying it and building it for that next investor that will come in 4 to 5 years.
Take it to the next level after.
Exactly.
Yeah, so I was going to say, take me through, I think a good jumping off point from where we just were was take me through, let's walk through the life cycle of a deal for y'all. Let's start with sourcing. How are y'all like finding opportunities? How's your team structured?
Yeah, absolutely. Well, look, we're thesis driven. So it starts within our 3 verticals of industrial services, healthcare services, and business services. We will identify macro themes that we want to play, and then identify subsectors within our 3 main verticals that are interesting. We'll do research on those sectors. We'll do white paper work to identify the fundamentals. Is a sector big enough? Is it growing fast enough? Is it fragmented enough? Have there been success examples? Do we have a real right to win in that sector? We'll then dedicate time and resources to that sector, so we'll fully staff a deal team. We do have a dedicated business development resource at Bow River as well that will assist in mapping that market, making sure that we're identifying all of the companies that fall within our target spec. We will then figure out how best can we get to those founders. Ideally, it's a company that's within the rodeo region, which we prioritize, where we do have deeper connections through our network, our investors, our service providers, bankers, so on and so forth. But ultimately, it's about making the connection with that founder and seeing if we align with them on the vision for what we all want to build in that sector. Is the value creation playbook one that we're simpatico on? Is there the right level of alignment with that founder? So on and so forth. Once you then have the deal, the terms agreed, you then proceed over to due diligence. That looks a lot probably like what others do, except for the focus that we have in diligence on the operational side. Everyone's going to go do a quality of earnings. Everyone's going to do tax diligence or IT diligence or legal diligence. We really seek to pre-wire the growth going in. So we'll identify what are the 3 value levers in that company. Give you an example, like in our mental health asset, one of the key areas we identified creating value was diversifying the company. It was 95% based in Florida at the time of acquisition. It was about 65% focused in Medicaid. We wanted to diversify that payer mix. We wanted to take them into additional geographies. So from the outset, as part of the diligence, in addition to all those third-party work streams that you're always going to do, we set about finding an add-on acquisition target that took them into the rodeo region in Texas. Massive market, as you know. Also helped to bring the multiple down going in, having that add-on. But we had a diversified platform. And then from a payer mix perspective, we spent a lot of time with their payer contracts, figuring out where there was opportunity for rate, where there were additional referral sources we could tap into, so we could quickly start adding commercial payers to that primarily Medicaid business, which has been meaningfully diversified in the year and change since we partnered with them.
Yeah, so now you've found an opportunity, you've underwritten it, talked about diligence. I guess step back for me really quick on, like, out of the business development side, is there like something that really tips y'all off to like, oh, this is an opportunity we really like? Is it the fragmentation, or like finding the like additional markets to go into, or like your growth piece that gets you excited to really run at it? Or how do you think about that?
It's being in a market where you have multiple ways to win. I mean, that's really what it comes down to. Like, we never want to be single threaded. Like, oh, the only way we can win is if we go roll up this industry.
Right.
There are folks who've done great doing that, but acquisition markets turn on you, debt markets turn on you. We want to have multiple ways to ultimately get to our return, and fundamentally for us, like, the organic and operations piece is what comes first. So to give you the same example of the mental health company, being focused on, okay, we can drive additional referrals with their existing payers. We can drive referrals with the new payer classes. We can go seek enhanced rates, right? Those are 3 different ways you can win organically. We can also add additional services, because they do a lot of therapy and counseling, but they don't do as much psychiatry or medication management. Same patient base, you're able to bolt on services there. And then we mentioned, pivoting that mix and diversifying the business. Like, that's where, in addition to scaling, while we don't ever underwrite multiple arbitrage, it should be there, right? As you scale a company meaningfully, make it more diverse, really build out the team infrastructure and systems. And so right there, you have multiple ways to ultimately get to where you want to go, even if the acquisition piece never comes to fruition.
Yeah, that makes a ton of sense. And then, all right, so you get through deal close and y'all own it now. What's your, like, y'all define like 100-day playbook,
Yeah,
post-close?
absolutely. And again, that all gets set before we close.
Yeah.
So we're aligning with that founder on here's what's going to happen in the first 100 days. More broadly, here's what the 4 or 5 year roadmap looks like. But that first 100 days is so critical, especially when you're first institutional capital into a company. Family-owned company might be owned for 30, 40, 50 years. Certainly you want to get the reporting and all the KPIs and whatnot right? A lot of firms do that. They'll hire, CFOs will do the same thing. Typically, it's the area that's typically lacking. But we also take a long look at systems and how we can integrate systems to get to ultimately what we want to look like in 5 years. That's a check we're more than happy to write up front. It's almost an investment you make, right, in the future, being able to have that data, have that visibility, because then you ultimately have the levers where you can drive the business and figure out, where you need to push, right? On the industrial services side, for example, we want to be able to see every single job that the company's doing, being able to say, okay, there's trapped margin here. These jobs aren't being bid correctly, have that all in a data lake where management can see it, every single day and ultimately manage the goals versus saying, hey, that's expensive. Like, why don't we wait 2 or 3 years?
Right.
Well, those 2 or 3 years are wasted in a situation where you really only have 4 or 5 years to get home.
Right. No, that makes a ton of sense.
That piece and the people. I mean, the people are also critical. Like, we'll make hires out of the gates. We'll align with the team initially on who are the folks that you want to promote up. Now that we're going on this growth journey together, great. Let's make sure they have the right incentives, the right alignment. They understand where they fit within the team and the culture. And then where do we need to go to the outside, right? What are the key skill sets we need? If we're going to go drive a bunch of referral-based sales, for example, and on the healthcare side, like, great, let's go hire a great VP of marketing, a CMO, someone who's built a world-class referral-based sales force before. Let's import that external organ into the company, and then let's let it grow and flourish, with early in the investment. So we're then benefiting and compounding that growth over the course of a 5-year investment.
Yeah, so we talked through post-close, kind of referenced hold period. I mean, is that defined or is more opportunistic?
It's flexible. We underwrite to 5 years. Our average hold's been less than that. That's been because we've typically hit our 5-year goals in a shorter time frame, and market conditions have been favorable where we've looked to execute on an exit. But no, look, certain markets turn. Certain companies have either opportunities you want to attack or risks you need to mitigate. And so we do our best to be flexible. We're also, it's not lost on us that we're in the private equity industry. We have, fixed closed-end funds. Our founder reminds us not infrequently that we're in the moving business and not the storage business. We are not a permanent capital partner. And so we're always thinking about how do we build this company to get to an exit, whether that exit is a year away and you're prepping for that sale, whether it's 3, 4, 5 years away and you're laying the groundwork of what you want it to look like, executing on all those different value drivers in an industry. So you're building the company that next buyer is going to pay a premium multiple for. Regardless, that exit's always something we're considering. Yeah,
it's coming. It's just,
it has to.
Yeah. I didn't ask you about size of deals. You said y'all are lower middle market. A lot of people define that differently. What's kind of your parameters for kind of EBITDA size and then check size as well?
Yeah, that's a great question. And look, lower middle market means a lot of things to different people. We really prioritize companies that are 7 to 25 or so of EBITDA. From a check size perspective, we're typically writing 40, 50, $60 million checks out of our current fund. We really like the lower middle market, right? There's a good bit of, we feel, alpha in the lower middle market, considering more companies are founder-owned, i.e. we can institutionalize and professionalize, and we can really align with those founders on what that second bite could mean to them, which usually means a more disciplined entry point than being in a situation where you're competing or buying from a sponsor that's prioritizing top dollar, having already taken that first step of institutionalizing the company and diversifying it. And frankly, it's fun. It's what we like to do. We're talking to our founders or management teams in many cases every day, multiple times a week. In other cases, all through the not just the C-suite, but even a layer down. Spending time on site with them, really helping to build the culture and the vision of what this all means. If we go out and execute, and look, there's a lot to do when you're scaling a company from 10 to 40, 50 million of profitability in a short period of time. We're nothing if not good for having hands that can pull on those oars and really help those teams get there.
Yeah, well, it's fun too, because to your point, you'd like to get to everything, but there's always something to do, which is like exciting.
No task is too small. It's something different every single day. Obviously, it's all executing on those core themes and value drivers that we're all setting out to execute on over the course of that partnership. But it's different flavors of things. You're interacting with different folks. Like in our seats, like we're learning every single day, and that helps, right? Because the next company, the sister company in that portfolio, or the company in the next fund, we're able to extrapolate those learnings, extrapolate from those relationships, and ultimately help make the next one even better.
Last work question before we move into like personal journey and growth journey. What you've mentioned the rodeo region a handful of times. I'm actually unfamiliar with exactly what that is.
Oh, come on, you live in Houston.
Wow. I have a feeling it's a different rodeo region.
It's congruent. So, yeah, it's a big point of differentiation for a firm. So we're based in Denver, Colorado. We do prioritize investments in the rodeo region within our private equity strategy. What's the rodeo region? Go one state in from California, and then the 14 states that line up kind of north to south from there through Texas.
Got it.
Why do we prioritize the rodeo region? Sure, it's nice being on hour-long flights and 2-hour-long flights, being able to take day trips. That's obviously conducive when you're spending time with your companies. But more importantly, there's certainly economic reasons why, right? The rodeo region is underinvested relative to the coasts, which have been more penetrated. It's a source of growing population growth. There are lower regulation levels of regulation across a lot of the states, which are more business friendly. But it's also really about the culture and the values. We're handshake's a handshake, your word's your word. Heads up partners with our teams. And so if you extrapolate beyond just those 14 states, we ultimately look for those values when we go outside the rodeo region, where hey, you could be in Florida, you could be in St. Louis. But ultimately, if you exhibit those values, you're going to fit squarely into who we are and where we play, versus the sharper elbowed, more coastal areas of the country.
Yeah, no, I've been doing a new segment called No Warmup. All right, pick a number 1 through 50.
24.
What's something people underthink? You can insert firm there too. What's something that other firms underthink?
Yeah, I think a lot of folks, just if we're tying this out to like business, right? Like a lot of folks, big focus on the numbers. They're asking, hey, how big's this company? How much revenue do they have? What are the margins? And all that's important. Like, make no mistake, there's certainly a threshold there. But the intangible elements are so much more important. And so when we're mapping companies to figure out, how we're going to prioritize a new thesis area, where we're going to seek to write a check.
Yep.
It's very easy to get lost in, well, this one has 100 of revenue, and this one has 75 of revenue, and this one has 50 of revenue. But the company with 50 might have the right founder, might have the right team. You might have the right alignment with those folks who are really underwriting that second bite, wanting to really double down and build with you for the next 5 years, versus the one that's got 100, might have different aims or motivations.
Right.
And so as we look at mapping markets, right, we certainly prioritize, but we try to be flexible, when the founder and the team and the opportunity all line up.
Yeah.
We're willing to say, okay, how do we solve for some of these other pieces, right? How do we get more diversified? How do we find a little bit more scale? Because this is the guy or gal that we ultimately want to back and work with, that's going to align with us and get us to where we need to go.
Yeah. Onto the personal side, how did you find your way into the private equity space? Was it something that you kind of aimed for during college, or fell into backwards?
Yeah, great question. I've always wanted to be an investor. Like, I bought stocks on an E-Trade account when I was a little kid, little tennis player who liked, Nike shoes and Andre Agassi growing up. And so bought the stock. That all turned itself into wanting to invest, and ultimately realized, despite working at a larger investment bank, that I was more geared to working with people and working operationally to solve problems versus being, larger cap focused, more financial engineering focused. Sure. And so frankly, I'm very grateful there's a recruiter who asked me to take an interview with the firm that I ended up joining, and she just knew that there was alignment there across how I wanted to invest, that firm and the people there, and the rest was history.
So which firm was that, your first shop that your recruiter found you for?
Yeah, so I joined Wald Capital Partners back in 2012, firm in Chicago focused on healthcare and business and tech services.
And then you went from there to another firm? Or
yeah, spent 4.5 years there. Ended up going to Chicago Pacific Founders at the start of 2017. I was really excited at that point to join a firm that was led by former operators and entrepreneurs who were looking to really grow as a first-time fund. Had the privilege of helping them scale across 3 funds, and then ultimately my wife and I looked at each other after 11 years in Chicago and realized we had no ties to the city.
Yeah.
We had jobs that we loved, people, friends that we loved, but knowing that we ultimately wanted to, expand our family, have a real support system, we figured, we needed to move to either Denver or Washington, D.C., and Bow River was looking for someone to lead healthcare services, to really specialize in healthcare services, and so feel very fortunate that that aligned with me needing to get to Denver, where we do have some family, and Bow River looking for somebody with my background.
Yeah, I'd like to ask usually a question around advice. If you were to start your career over again, and think about it through the lens of someone like coming out of college,
Sure.
What would be, like, would you change anything, or did you like the lane that you kind of pursued?
I like the lane. Like, I'm very happy. I feel fortunate every day to be able to wake up and do what I do. I heard an anecdote or a comparison earlier in my career that said, hey, being a junior guy in private equity, it's like having an apprenticeship in business. Like, you had to touch everything. You have to talk to folks that are way more experienced than you across a number of areas, and they're relying on you to deliver for them every day. So I wouldn't change much, but it's tough to say, being like an investor. Like, we're cynics for a living, right? You're going and doing diligence, you're looking to find the risks, find the issues, then mitigate them. The advice I'd give someone else, or frankly myself going back, is like, don't be too cynical. Like, walk into something, see the best in it, always focus on how can I solve this problem. Because I even see it today, I see it in myself to an extent, I see it in teams that we work with. It's easy to say no. Anyone can say no. The right solution, though, sometimes is saying no, but sometimes it's, all right, here are the issues, here are the risks. How am I well suited to mitigate those? Because that's where you find opportunity.
Right.
Everyone's looking at the stuff that's straight down the fairway. That's easy. Pardon the pun. I know we're sitting here on a golf course, but ultimately, can you hit it out of the rough? Can you figure out how not to aim? I'm trying to think of all the bad metaphors I can now, but how to not aim at the pin that's on an island, maybe the fat part of the green, get yourself to safety and still get home. Because those are the opportunities that'll cross your desk more often than not.
Right, yeah. Just looking around the corner at the positives instead of just the reasons to pass.
Exactly.
Yeah.
Exactly. And it's easy as a junior guy to just get trapped in that and say, yeah, we'll never do that. That doesn't work. Versus, okay, here are the issues, and then here are the 3 people I should call. Here's the, what I've seen in other deals that I can leverage. We can solve these 2 things. We might be able to solve this one if we get this guy or gal engaged. All right, we have a path. Like, let's proceed.
I love that.
Sorry for all the metaphors.
No, thanks for playing. It was fun. Glad we got out on the course outside of the conference walls.
Appreciate you having me. This is a blast.